Most Singaporeans can tell you the price of a stock, but almost none of them can tell you whether that stock is actually safe to own at 55. That gap between the headline number and the forensic reality is where retirement portfolios quietly come apart. And today I want to close it for good. If you have been following Iggy for a while, you have probably heard terms like gearing ratio, interest coverage ratio, and distribution yield thrown around in the deep dives. And if you have ever felt like those terms were explained too fast or assumed too much background knowledge, this piece is specifically for you. I have been watching retail investors struggle with this for years, and it is time to lay out the foundation clearly. Before we get into the numbers, I want to say who I am doing this for. Not the trader with a 20-year runway, not the growth chaser hunting the next 10-bagger. I am doing this for the retiring and retired Singaporean who needs their capital to work reliably, not spectacularly. When you are managing retirement capital, you cannot afford to treat your portfolio as an expensive learning experience. I have been covering the Singapore exchange long enough to know that the question most retail investors ask is simply, what does this stock pay? That is the headline number on every stock screener and broker platform. But the critical question they should be asking is, can this stock keep paying it? We are going to cover the free checks in plain language with real financial consequences attached. We will also look at how transaction costs quietly erode your returns before you even make your first trade. Let us start with the framework that sits underneath every Iggy verdict. When I assess a stock, I am not just asking whether it pays a dividend. I am asking three fundamental questions. First, is that dividend structurally sustainable? Second, can the balance sheet survive a sudden rate shock? And third, does the yield actually compensate you for the risk you are taking? Together, these create a traffic light system, but with 5 zones instead of 3. This is the 5-zone framework. Zone 1 is fortress territory, meaning a clean balance sheet and a yield above the hurdle, suitable for accumulators and drawdown investors. Zone 2 is the watch list, where it passes most gates but has one minor flag, requiring quarterly monitoring. Zone 3 is conditional, carrying 2 soft flags and suitable only for accumulators taking a small position. Zone 4 is caution, meaning one hard gate failure where you reduce exposure. Zone 5 is the red zone, meaning multiple hard gate failures where capital is actively at risk. Within that framework, there are hard gates that are completely non-negotiable. The yield must be above 4.7%. The gearing ratio must be below 35%. And the interest coverage ratio must be above 4 times. These are the absolute foundational thresholds. A single hard gate failure immediately drops a stock to zone 4 at a minimum, regardless of how good everything else looks. There is absolutely no compromising on these numbers. If you want to properly protect your principal, you might be wondering why this zone system matters so much for a beginner. The reality is you do not need to read a full 300-page annual report to get oriented. You just need to know which zone the stock is in and what that zone means for someone at your exact stage of life. The zone that is right for you depends entirely on whether you are an accumulator still working and building or a drawdown investor relying on the income. A crucial distinction here is that a red traffic light always turns green eventually, but a Zone 5 stock does not. When gearing exceeds 45% and the interest coverage ratio falls below 2 times, the company is not pausing at the red light, it is running out of road. Retail investors are conditioned to wait out volatility, but forensic investing asks whether this is a timing problem or a structural problem. Zone 5 is almost always structural, and waiting for it to recover is not patience, it is just hope. And here is where the most costly misunderstanding in retail investing lives. When you put money in a CPF special account or a fixed deposit, the interest payment is contractually guaranteed. The bank or government must pay it. A dividend does not work this way. A dividend is a decision made by a board of directors every single reporting period, based entirely on what the company can actually afford to distribute. Think of it exactly like a fruit tree in your garden. A healthy fruit tree produces fruit reliably season after season, assuming good soil and adequate water. You can plan around that harvest. But if the roots are being crowded by debt, or if the tree is being forced to produce more fruit than it can naturally sustain, one dry season is all it takes for the harvest to fail. Unlike a bank deposit, nobody is legally obligated to top up your basket when the company has a bad quarter. There are 3 clear warning signs that your fruit tree is struggling. First, a yield funded by capital rather than earnings, indicated by a net loss despite a high payout. Second, sponsor top-ups that inflate the distribution, meaning organic income is actually lower than the headline figure suggests. And third, a payout ratio above 100%, which means the company is literally borrowing money to pay you. A 14% yield from a company reporting a net loss at the shareholder level is not a gift. It is a glaring warning. Which brings us to the 4.7% hurdle rate. The CPF special account currently pays 4%, which is guaranteed, government-backed, and carries zero balance sheet risk. Any equity position yielding below 4.7% is failing to compensate you. Below that line, you are not being rewarded for equity risk, you are just being flattered by a number. Above 4.7% is where taking equity risk finally begins to make mathematical sense for a Singaporean investor managing retirement capital. Now let us look at the first balance sheet test, which is the gearing ratio. This measures how much of a company's assets are funded by debt rather than equity. My hard ceiling is 35%. Anything below 30% is absolute fortress territory. Between 30 and 35 is a hard ceiling where you must monitor closely. Above 45% puts you firmly in the Zone 5 red zone. High gearing is exactly how a seemingly stable dividend becomes suddenly unsustainable when rates rise. The second balance sheet test is the interest coverage ratio, which tells you how many times over a company can pay its interest bill from its operating earnings. An ICR of 4 times means the company earns $4 for every $1 of interest it owes, providing a safe buffer. An ICR of 2.5 times means there is very little buffer, placing the company in danger. My absolute minimum floor for retirement-grade holdings is 4 times. Anything below 2.5 means you are one rate shock away from stress. So what does the balance sheet data actually show us in plain language? Gearing below 30% and ICR above 5 times means Fortress Zone 1. Gearing at 30 to 35% and ICR at 4 to 5 times is Watchlist Zone 2. Gearing at 35 to 45% and ICR at 2 to 4 times is Caution Zone 4. Gearing above 45% and ICR below 2 times is Red Zone Zone 5. Both of these numbers are freely available on SGX StockFacts and your brokerage platform. No spreadsheet required. In the world of dividend investing, we spend a lot of time talking about the yield spread, the difference between what a stock pays you and the risk-free rate. But there is a hidden leak that most retail investors completely ignore: transaction friction. If you are deploying $10,000 into a Singapore REIT and your broker eats a chunk of that in minimum commissions or platform fees, you are starting your investment in the red. Data is only useful if you have the tools to act on it without getting eaten alive by those fees. That's why I use Longbridge. They are currently the only platform in Singapore offering lifetime $0 commission circumflex for US, HK, and SG stocks. Their data visualization is also some of the fastest I've used, which is critical when you're timing an entry in a volatile market. To help you plug that leak, I've partnered with Longbridge for a specific pilot program. For the first 10 readers who open and fund an account with a minimum of $10,000, they are offering a direct $100 cash credit on top of their generous welcome rewards. Simply, if you deposit $10,000, hold it for 3 months, and complete 5 buy trades, you will receive an exclusive $100 cash coupon, $300 worth of NVDA shares in total, as well as a 10% interest boost coupon valid for 180 days valued at $98. Why does this math matter to a forensic investor? Because $100 on a $10,000 deposit is an immediate 1.0% day one yield boost. It is the simplest way to neutralize transaction friction and protect your margin of safety before you even buy your first share. This is a one-time pilot strictly limited to the first 10 spots. Link and full terms are in the description. Other fees and terms and conditions apply, so read those first. But for a forensic investor who cares about entry cost, this is worth 5 minutes of your time. You now have your 3-check forensic starter kit ready to deploy. It consists of the zone check, the fruit tree test, and the balance sheet test. None of these require a finance degree or a complex mathematical spreadsheet to understand. They simply require you to know exactly what to look for and what it means for your portfolio, whether you are at 50, 55, or 60. This is all about making sure you never treat your retirement capital as a speculative gamble. Here is the 3-check checklist summary. For the zone check, ensure it is zone 1 or 2 for retirement capital. For the fruit tree test, ensure the yield is funded by operating earnings only, with no sponsor top-ups and a payout below 100%. For the balance sheet test, demand a gearing below 35% and an ICR above 4 times. Failing a check does not mean you cannot own the stock. It means you must understand exactly what structural risk you are taking. To show why context matters, look at 2 different investors holding the exact same stock in Zone 3. The accumulator at age 52 has 15 years until drawdown and can hold the Zone 3 position with immense discipline and a clear exit trigger. But the drawdown investor at age 63 is living off distributions and cannot afford to wait. For them, Zone 3 is completely inappropriate. Same stock, completely different answer based on your specific life stage. Forensic investing is not complicated. It is highly disciplined. The same 3 checks we have walked through apply to every single name I cover in my analysis. From the Zone 1 Fortress REITs that let you sleep well at night, to the Zone 5 positions that should never have been held at retirement weight in the first place. This process is how we separate the yield traps from the genuine income generators. If you want to see these exact 3 checks applied to real stocks in real time, Iggy's Elite Investors is where we do the heavy lifting. You get the full soft flag breakdown, comprehensive zone trajectory commentary, and 0-day access to every forensic audit before the free versions ever drop on YouTube. Start with the balance sheet because absolutely everything else follows from there. The link to join the community is in the description below, along with those first 10 Longbridge platform spots. We have covered the fundamental checks that separate a resilient retirement portfolio from one built entirely on hope. Ignoring these balance sheet realities is exactly how retail investors get trapped in yield traps when macroeconomic conditions tighten. I am Iggy, forensic investor, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's Elite Investors get 0-day access, link in the description. The window is already open. We operate on a strict 7-day embargo window before the free versions drop, giving Iggy's Elite Investors 0-day access to the data. Check the link in the description to secure your spot. This video is a paid partnership with Longbridge Singapore. It is intended for general awareness and does not constitute investment advice or a recommendation to buy, sell, or otherwise engage with any investment products or financial services. The presenter is not a licensed financial advisor and is not offering financial advice. All views expressed are solely those of the presenter and do not necessarily reflect the view of Longbridge Singapore. All investments carry risks, may not be suitable for everyone, and you may lose your investment principal. Past performance is not indicative of future results. You should seek independent financial advice if you are unsure about any investment decisions. This advertisement has not been reviewed by the Monetary Authority of Singapore.